I want you to ask yourself, hey, like what didn't go as planned and what do I want to do differently or do better next year? Did you plan to save more, but somehow you ended up not saving more? Or did you plan to finally get that estate plan done, but it's still sitting on the to-do list? Maybe you plan to really tackle that debt reduction, but somehow that balance is a little bit higher than what you want it to be. Right? So typically, there's the plan, something that didn't go well, and maybe there's a reason. My question is just, hey, what are you going to do differently? Or what are you going to do next year to make sure that you have the outcome that you want?
You're listening to The Pilot's Portfolio, the show dedicated to guiding professional pilots towards a future of financial success and stability. Fly along with your host, Timothy P. Pope, as he provides financial planning insights and answers to your burning questions and dives into real-life stories from fellow pilots who share their successes and cautionary tales. The Pilot's Portfolio takes off now.
Well, welcome to this episode of Pilot's Portfolio. My name is Timothy P. Pope. I'm a certified financial planner, principal at 360 Aviation Advisor, GA pilot, and your host. Guys, I'm glad you're here. In today's episode, we're going to talk about several things. But one thing that I'm thinking about, and it's frustrating me, is this upcoming tax grab that is coming to you in 2026. I think you should be aware of it. It's super obvious. We're going to talk about that. But we're going to talk about some other things as well. Let's talk about some of those things and we'll save that for a little bit later. But guys, I don't know about you, but as we approach the end of the year, every year, I always get a little bit reflective. Just thinking about what went well and next year what I'd like to do differently. This goes to a lot of aspects in life, but financially, definitely is one of those areas. So I want you to think, what is one of the things that you knocked out this year? Maybe you set out to do it. Maybe you didn't set out to do it and you just ended up doing it. But what is one financial achievement that you accomplished this year that you feel really good about? Was it, hey, you bought a new home? Maybe you upgraded. Maybe it was the first time. Celebrate that. Was it that you hit a savings target? Whether that's in the 401k or the brokerage account, maybe you just started saving and you just started automating something and you feel good about that. Celebrate that. Maybe it's you pay down debt and you feel really good about that. Maybe you took a big trip, that you planned for and boom, you spent a lot of time planning, spent a lot of time thinking about it, saving for it. You spent some time paying for it and then you executed. Whatever your success was, I want you to just take a moment, bask in that success, be happy about it, right? Appreciate the fact that you accomplished it. Matter of fact, as I'm talking about this, it's making me think about, goodness, it feels like forever ago. It was just earlier this year. A year ago, I was planning it, but earlier this year, my wife and I celebrated a milestone anniversary. And so I flew us to a place that she's wanted to go for a while. And it was all planned and all surprised, right? So flew us out there. I don't fly private aviation, right? It's I'm not your NetJets or your FlexJet client. So it was super cool for me to fly us there. We get there if the airport's, closed, but we had the rental car arranged and everything. So just boom, picked it up and kept going. And then I think it was the next day, I had a photographer meet us out on the beach. My wife got a new ring out of the deal, which was super awesome. And she said yes, so she agreed to stay married to me. So that was a nice win for me, I could say. So yeah, that happened. Man, it seems like forever ago. But yeah, that happened earlier this year, and I feel really good about that. So I'm sure that you guys have similar stories and accomplishments, whether they were strictly financial, or maybe it was a life event like I just shared. But we know that these memories that we work hard to create and share with those that we love, most of the time are not free. Most of the time they involve some financial resources. So bask in that success. Pat yourself on the back. Be happy about that. Also with this reflection, typically there's two sides to every coin, right? And so I also think about like, hey, like what didn't go as planned and what do I want to do differently or do better next year? And I want you to ask yourself that as well, right? Did you plan to save more, but somehow you ended up not saving more? Or did you plan to finally get that estate plan done, but it's still sitting on the to-do list? Maybe you plan to really tackle that debt reduction, but somehow that balance is a little bit higher than what you want it to be. Like, right? So typically, there's the plan, something that would go well, and maybe there's a reason. My question is just, hey, like, what are you going to do differently? Or what are you going to do next year to make sure that you have the outcome that you want? And sometimes it's, there's so many people I talk to and they say, man, I've been thinking about working with a financial planner for years and I'm finally getting around to do it. It's like, maybe that's you. Maybe next year, 2026 is your year to just really lean in and organize your finances and optimize them. And as I was saying, like, hey, there's two sides to every coin. Maybe one of the things that you had wanted to accomplish or plan to accomplish this year was moving to a different property. And for whatever reason, interest rates were stubbornly high. Prices, although they're starting to slide, they haven't come down to where you feel comfortable pulling the trigger on that. So maybe that's one thing that didn't go as planned. And speaking of moving, if you listen to the show, you know about Beacon Relocation. Speaking of moving, if you expect to move by the end of 2025 or the end of 2026, and you haven't heard the October 13th episode, so that's season 2, episode 17, go give that a listen because Beacon shares how they're going to help you save more money on your next real estate transaction between now and the end of 2026. And all you got to do is go give them, first get the promo code and then give them a shout and say, hey, I'm thinking about moving, right? That's it, between now and 2026. So go give that a listen. And then if that applies, follow the appropriate steps. So, there's so many possible stories that you guys may have on what went well and what you plan to do differently. So reflect on that. I'd love to hear the success stories. Like, shoot me a note, info@pilotsportfolio.com. Like, tell me what you accomplished and let's celebrate that together. All right, down to some changing numbers that I think you should be aware of. Yeah, let's talk about contribution limits because 2026 is going to see some changes in contribution limits. Let's start with the 401k first. So this is probably your largest retirement account. The amount of money that you can put in from salary deferral and choose to be either pre-tax or Roth, that amount is going to go up to $24,500 in 2026. And that is up slightly from $23,500. So it's up $1,000 from the 2025 number. The total of what you can put in and what your employer puts in. So now we're thinking about that NEC, that number is going up. So in 2025, it's 70,000. Next year in 2026, it's going to be 72,000. So that number is going to go up a little bit. Also, sticking with the 401k, those catch-up contributions. If you age 50, your catch-up contribution is going to go up by $500. So right now in 2025, it's $7,500. And in 2026, that catch-up contribution is going to go up to $8,000. And then there's this thing called a super catch-up contribution. I think that a few episodes ago, I talked about it and it was in a different context and a different light. The super catch-up contributions, it's relatively new. It just was passed recently with the Secure Act 2. And the thing with the super catch-up contribution is if you are between the ages of 60 and 63, in 2026, you're going to be able to put in not $8,000, but you're going to be able to put in $12,000. Okay. And I want to make a note with these catch-up contributions. The catch-up contributions do not count against that $72,000 maximum between you and the employer. Completely different section of the revenue code. So that's going to be in section 415. I'm sure you don't want to know that. But these catch-up contributions are in a different section. Your salary deferral, your $24,500 plus your NEC can cap out to 72. Then if you're 50, you're going to be able to put $8,000 on top of that. If you're between 60 and 63, you're going to be able to put $12,000 on top of that $72,000 number. So there's some of you guys that are going to be able to tuck away 84 grand before getting spill cash or before that spill cash is tucked away into your cash balance plan for you. As that Papa John's commercial from I don't know, 10 years ago, that guy says, right? He says, that's a lot of dough. And it is. That's not chump change. 84 grand that you can put away. And by the way, with it being in your 401k and not your cash balance plan, that means that you can actually control the investments. And I think that's a big point to note. Some other contribution limits that are changing is your IRA and your Roth IRA contribution limits. Okay, so with your IRA and your Roths, that's going to go up by $500. This year, your IRA, your Roth IRA contribution limits $7,000. Next year, it's going to be $7,500. And then, of course, if you're age 50, you can throw in an extra $1,000 on top of that, right? So for a total of $8,500. Your HSA contribution, those contributions are going up a little bit, right? So if your high deductible health plan covers a family, you're going to be able to put in $8,750. And if your high deductible plan covers an individual, then just you're going to be able to put in $4,400 in your HSA. If you're age 55 and older, you can put in an extra $1,000. Just note that the HSA has a higher age. For the retirement contributions, it's 50. For the HSA, it's 55. And I've seen this done, and it's completely legal. If you and your spouse both have independent coverage in your HSA, meaning it just covers you, and then your spouse's high deductible plan just covers your spouse, and you're both over the age of 55, you can both put in that $1,000 catch-up contribution, and together you guys will have $10,800 in your HSA's contributions for the year instead of the $8,750. So hey, a little bit more money in the HSA. Let's remember, HSA contributions are tax deductible, and then when you use them, the money for qualified health expenses, they're also tax-free. So you can do that. Just make sure that it actually makes sense for you to have two different health insurance plans, and you're not going to be paying more than the difference there. That'd be $2,050. You're not going to be paying more than the difference there on premiums or other out-of-pocket costs, right? It needs to make sense.
Hey, pilot, are you looking to save 20% on the sale or purchase of your next home? Let me tell you about a friend of the show, Beacon Relocation. With Beacon's exclusive real estate benefit, you can save thousands. My family has actually used their services when we needed to sell a property that was multiple states away. Beacon has over 1,500 experienced agents providing outstanding service and expertise as they guide you through every step of the buying or selling process. They'll even connect you with a national lender who offers competitive rates and discounted programs. As a Pilot's Portfolio listener, you are eligible to receive 20% of the real estate agent's commission towards your closing cost on the sale or purchase of your home. Visit beaconrelocation.com today. Select Pilot's Portfolio via the Apply Now drop-down menu to activate your benefits and make your next move your best move.
Buyer credit varies in some states. Contact us for details.
Let's talk about the new catch-up contribution rule that is going in effect in 2026. Okay, so you guys just heard me say that if you are age 50 and above, you could do $8,000 catch up. And if you're 60 to 63, you could do $12,000 catch up. And the new rule says that if you're age 50 and you've earned $145,000 from your airline last year, then your catch-up contribution will be required to be a Roth contribution starting in 2026. That is nothing but a tax grab, because just like several years ago when Congress took away the stretch IRA, and now they're requiring inherited IRAs in many cases to be emptied within 10 years, that's a huge tax grab. I mean, it just accelerates the taxable revenue for the IRS. This is the same exact thing. If you're 50 and you've earned $145,000 from the airline, any company, but this is the Pilot's Portfolio, so we're focused on the airline, then you're going to have to make that catch-up contribution in Roth dollars, meaning it's going to be taxed going in, and you're unable to make it in pre-tax dollars and defer those taxes. And let's just think about this. That $145,000 in earnings, that's just yours. So let's say you have a spouse and your spouse earns $145,000. And let's say your spouse wanted to make a catch-up contribution in their 401k. Well, the IRS says, sure, you can make that catch-up contribution, but it's going to have to be Roth. But here's the thing. If you and your spouse, still making that same 145 each, wanted to make a Roth IRA contribution, then the IRS says, whoa, no, you can't do that because your combined modified adjusted gross income is above the $236,000 threshold limit. You make too much money, you need to consider a backdoor Roth conversion. But on the 401k side of the house, they're saying, hey, you make 145. No, you need to make those things Roth. That's ridiculous. I think, if the IRS is going to force your catch-up contributions to be Roth, then they should at least remove the income limit for Roth IRA contributions for that same age group, 50 and older, to at least be consistent. And the frustrating thing about this is it's like, and this is not lost on me, $145,000, come on. That is anybody at year 2 at a major airline with very, very few exceptions. Okay. And so it's not lost on me, nor is it lost on the IRS that, hey, at age 50, you are likely getting close to your top earnings. Now, in the airlines, I think it's a little different because you guys got the seniority and you go till 65. All right. So you're probably not at peak earnings at age 50, probably. But for folks outside the airlines, they probably are getting close to it. But here's the point. So that, 145, okay, if you're getting close to max earnings, that means you're also climbing up the tax brackets, which means the IRS is it's a tax grab, right? Whatever your marginal is, you multiply that by 8 or 12. If you got a spouse and they're going to do the same thing, so multiply whatever your marginal tax rate is by 16 or 24,000, and there you go. There's a little bit more revenue for the government. That's what's frustrating, but it is coming. So if you're somebody who had previously planned to make those catch-up contributions and you had previously planned to make them pre-tax, and next thing you know that you're unable, well, this is why. So just be aware. And here's the thing too. I love Roth just as much as anybody else, but I do understand that there's a point, particularly depending on what state income tax that you are in, and then your marginal federal bracket, there's a point where in a lot of cases, it makes sense to transition your 401k contributions to pre-tax because the savings do become substantial whenever you go from Roth to pre-tax, okay? That being said, we work with clients about making, even if I've switched my 401k contributions from Roth to pre-tax, we're still interested in maxing out Roth shelf space in the way of a Roth IRA and doing a backdoor. It's a decision tree. Hey, I maxed out my 401k. My next dollars, do I want them to be in a brokerage account where those dividends and capital gains are not going to be shielded and I will have to pay taxes on those at some point? Or do I want to be in a tax-free account? And typically when we get to that point, a $7,000 contribution year over year is, it's not a game changer, but certainly, if the shelf space is available to me, I want it, right? And so, I love Roth just like anybody else, but I do understand that there's nuances in terms of planning, and the planning can make a big difference. Now, here's the other thing. Let's do a quick review of the differences between the 401k and the IRA, because we use the same language. We use Roth and pre-tax in both cases, but they can be different things and there's different rules. It's not lost on me that I do this every day. And so let's just do a quick little review to make sure we're on the same page. So when we say Roth, that just means tax structure. Okay, that means I've put in after-tax contributions. I've already paid taxes on these contributions, or I will be paying taxes on these contributions. And then when the money comes out, my earnings will be tax-free. That's what Roth means, right? And then pre-tax is the opposite, right? So I'm putting money in, I'm taking a tax deduction now, but then in the future, when I take the money out, my earnings, I'll have to pay tax on my earnings and on my contributions, in fact. And so Roth just means tax structure. Now, 401k and IRA are account types. So think if you've got different accounts, different account types, you got different rules. All right, so your 401k is going to be really big contribution limits, like we just talked about. Your employer, your airline is going to be able to put in money for you through the NEC. You're going to be able to choose, of your 24,500, if that money goes to Roth or if it goes to pre-tax, right? So that's the 401k side. On the IRA side, the I actually stands for individual. So it's all you, right? Like you put money in there. There's a much smaller contribution limit. So it's that $7,000 this year, $7,500 in 2026, plus $1,000 if you're age 50 or older. And so those are the key differences between the 401k and the IRA. They can both be Roth or they can both be pre-tax, but different amounts and then different rules as we just went through. And it used to be every time you would hear like, hey, I was told that I made too much money and I'm not able to do a Roth. I mean, that would always be, hey, well, that meant you can't do a Roth IRA and you can still do Roth 401k. And oh, by the way, here's this backdoor way to get into, and it's completely legal. Here's this backdoor way to get into a Roth IRA anyway, right? So that's used to be what it is. Now I expect you'll hear, hey, I've been told that I made too much money. I have to do Roth. And that conversation is going to be, well, only on your catch-up contributions in your 401k. You're still going to have a choice on that first 24,500, whether you direct that to pre-tax or Roth. And believe me, it's not a set it or forget it, because as you climb the tax brackets, and that can make a huge, huge difference. So that's everything I wanted to go over in today's episode was, hey, we got these 2026 changes coming up. Wanted to share that tax grab that's coming for you in 2026, especially if you're age 50 or older. By the way, if you're between 60 and 63, you've got the extra money that you can put in. And then, as we talked about in the beginning, we just reflect, right? Like reflect on the things that went well this year and celebrate that, right? And then think about what you're going to do different next year and then get busy. So with that, guys, thanks for joining this episode. By the way, love hearing from you guys. So please do continue to send your questions, info@pilotsportfolio.com. We'll get those addressed. We'll see you on the next episode.
Thank you for joining this episode of Pilot's Portfolio. If you found this information helpful, spread the word and share it with a Pilot buddy. Or if you have questions and there's something that you would like to hear discussed on the show, send us an email. You can find the address in the show notes. For those of you who are ready to learn how we help professional pilots with their financial planning needs, schedule an appointment. Until next time, keep the shiny side up, and we'll see you on the next episode.
Pilot's Portfolio is hosted by Timothy P. Pope. Timothy P. Pope is principal owner of 360 Aviation Advisors. 360 Aviation Advisors is a registered investment advisory firm regulated by the state of North Carolina in accordance and compliance to the securities laws and regulations. 360 Aviation Advisors does not render or offer to render personalized investment or tax advice through Pilot's Portfolio. The information provided is for informational purposes only and may not be suitable for all investors and does not constitute financial, tax, investment, or legal advice. All investments involve a degree of risk, including the risk of loss.